For the first few years of the generative AI boom, the biggest question was simply who could train the smartest model. But underneath that software race, one company emerged as the primary hardware provider, manufacturing the graphics processing units that make this computing possible: Nvidia. These models do not exist in the cloud by magic. Every single query you type into a chatbot requires a tangible response from a physical machine, supported by dense networking equipment and industrial cooling systems. This translates to millions of physical servers, drawing immense amounts of electricity, housed inside vast concrete data centers that are continuously expanding across the globe. Building at this scale costs billions. Even the most profitable technology giants face limits when trying to fund a multi-trillion-dollar global infrastructure build-out exclusively from their own corporate cash reserves. The raw capital required to build these facilities has become a constraint as significant as the technical challenges of the AI models themselves. On August 10, 2026, Nvidia announced a partnership with major financial institutions, including Apollo, BlackRock, and Goldman Sachs. The goal was to mobilize $500 billion in funding for AI infrastructure. Under this arrangement, Nvidia agreed to potentially backstop up to $125 billion of these deals, while relying on third-party institutional capital for the remaining $375 billion. Curious, historically, Nvidia focused on designing and manufacturing semiconductor chips. Now, CEO Jensen Huang is helping coordinate the immense financing required for his customers to actually buy those chips. This $500 billion financing initiative ties the AI boom to Wall Street, creating a massive new asset class alongside the ongoing research in Silicon Valley labs. Jensen Huang describes these new data centers as AI factories, facilities that take in raw electricity and data to manufacture intelligence. This is how traditional infrastructure is funded. When developers build a power plant, investors provide the capital upfront, and the steady revenue generated by selling electricity over many years repays that debt. Nvidia wants to apply this model to computing. The power plant becomes a data center rack. Institutional capital buys the hardware, and the future revenue generated by AI software users is used to service the debt. Nvidia sits at the center of this loop. Because they are the supplier, they receive payment immediately from the pool of third-party capital, long before the data center generates its first dollar of profit. Treating computing capacity like an infrastructure asset removes the massive upfront cost barrier for startups and cloud providers, allowing them to expand their hardware footprint at high speed. But there is a glaring difference between an AI factory and a physical bridge. A concrete bridge can operate steadily for 50 years. Cutting-edge computer hardware loses its value much faster. Nvidia constantly releases new architecture. A single generation of chips is quickly superseded by faster, more efficient silicon, meaning the premium components installed today may become economically unviable in just a few short years. This raises a critical question. What happens to the massive debt if a newly financed data center's chips become obsolete before the infrastructure is actually paid off? By utilizing third-party capital for these projects, Nvidia ensures the depreciation risk sits with the outside investors rather than on its own corporate balance sheet. The financial institutions providing the loans, the banks, private credit funds, and insurers, now carry the risk of the hardware losing its value. This financing model shifts the potential impact of an AI bubble from a single technology company to the broader global financial system. History shows that investment booms often end poorly for investors, even when the technology is transformative. The internet and electricity were both real technologies that nonetheless saw massive capital destruction. During the railroad era, enormous fortunes were lost because investors laid thousands of miles of track far ahead of actual consumer demand for the service. This is why the $500 billion investment figure is not the most important number. The survival of this entire system depends on actual, sustained revenue from end users. Consumers and businesses must purchase enough AI products to cover high interest debt, the electricity costs, and rapid depreciation of servers. Building massive capacity today based on projected revenues that have not yet arrived matches the historical pattern of a financial bubble. By turning data centers into a widely held financial asset, the growth of artificial intelligence is now tied directly to the macroeconomic credit cycle. The future depends on whether AI productivity successfully pays for itself, or if the industry has created a massive physical overbuild constrained by expensive debt. Nvidia has secured its place as the creator of the hardware powering this expansion, while simultaneously architecting the financial system required to deploy it. Nvidia provided the essential hardware for the AI revolution and helped build the bank that financed the entire gold rush.